I myself am an entrepreneur. And when you're an entrepreneur, you tend to have a lot of tax write-offs. So you don't qualify on paper to purchase these properties, right? Because you've got a great tax strategist, you've got a great CPA, and they're working in tandem to make sure that you're paying the least amount of taxes. But also for a conventional loan, that it's, oh, I'm only making $40,000 a year, or $50,000, or whatever is going on in your scenario. You're not going to be able to qualify for some of these over and over and over again with a conventional. So these loans are perfect for entrepreneurs who have great tax strategists, great accountants, and have a lot of write-offs.
Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things real estate, finance, and entrepreneurship. And I'm super excited to talk about a concept that's called debt service coverage ratio financing, or DSCR lending. And my guest is one of the nation's premier experts on that, and that is Bridget Brick. Bridget, how are you today?
Very good. Happy Thursday.
Happy Thursday to you too. Let's get right into it. Tell us, what is debt service coverage ratio financing, DSCR financing?
Sure. So I'm a DSCR lender. DSCR stands for debt service coverage ratio. And essentially it's asking, is the debt serviced by the income the property will make? So when it comes to qualifying for one of these loans, it only takes three things to qualify. One is your credit score. You need, well, I have loans that go below a 600, but I would say for the general max LTV, you need a 680 credit score or higher. With liquidity, you are going to need at least 20% down payment and closing costs. You will also need to show that you have 6 months reserves in an investment, retirement, or crypto account, but we don't escrow that part. So that's for your liquidity. And the third thing is with the income qualification portion of the loan. We don't look at your income to qualify. Instead, we look at the income that the property is going to make. And does that income equal and cover the PITIA, or principal, interest, taxes, insurance, and association fees?
Exactly right. Wonderful. So thank you. Thank you really much. What does that mean for people? Like who is a perfect customer for you? And paint the scenario of like,
Sure.
When would somebody need such a loan?
So these loans are really built for the everyday American, and they are built for folks who cannot, a couple of reasons, but here are the general reasons why you would choose a DSCR loan over conventional. Number one, you don't qualify for a conventional loan. So maybe you have maxed out your conventional loan borrowing, or your debt to income borrowing power is wiped out and you don't look like you can take on any more debt versus the income that you have. So that would be scenario number one. Scenario number two is if you
So in the first scenario, let's say, so somebody has a bunch of debt, perhaps the bank, some banks only finance like a certain number of loans or certain amount of houses, and you just now found another opportunity. It's a rental house. It's a great deal. It's high rent, low price. Basically, the rent covers the full debt service coverage ratio and maintenance and every kind of things included. And the bank says, well, great, but you're at our capacity. We can't lend you any more money.
You're out of luck, essentially. And so what people have tended to think in the past is if you're out of luck on conventional, you have to save up all this money and pay cash for any future rental properties. And we sit in between those two extremes. So if you can't get qualified for conventional and you don't have $200,000 to buy something with cash, we are the loan product that sits in between those two things. So it really allows for you to have another option once you as a family have maxed out your debt for your household expenses, your primary home, your cars, whatever it is.
Yeah, so it's not a non-qualifying loan because you still have to have a certain credit score. So you're going to be underwritten to at least a little bit. But it's a loan where the main qualifier is the actual property that you're investing in and its income.
Right. The property is underwritten like a business. So these are in the marketplace. These are also called business purpose loans, but they are for real estate. So just like anyone who's looking to purchase a business is going to look at the balance sheet, the cash flow, what does it cover? We're looking at the same thing. Does the rental income cover all the expenses associated essentially with the house?
Yeah, exactly. That's beautiful. So this is an alternative investment strategy, an alternative financing strategy for rental properties that either have high equity or if they're in higher priced areas, you probably have to put more down for it to make sense. Or in lower priced areas that still don't have super low rents. So where is there any kind of geographical trend of where most of your loans come from? I would assume not the Bay Area, where every little dog house is worth $1 million, and or perhaps yes, because rents might be 5 times higher either, five times higher too.
It depends your strategy. So my website, Get Brick Capital, lays out different strategies that you can implement in your, I guess, investment algorithm, if we call it that. And really, if you want high cash flow, but you don't have a lot of money to get into properties, you're going to end up buying properties that are meant for Section 8 or essentially properties that are about $80,000 to $100,000 to purchase and that rent for $1,300, $1,400, $1,500 a month. Now, those areas are going to be, you know, Detroit, Cleveland, Philadelphia, different places like that. If and obviously when you buy a lower priced home, as it increases in value, the amount that it increases in value is less than if you buy a mid-range home. So if you have a little bit more money down and you don't care as much about cash flow, but you care a little bit more about appreciation over time, you're going to end up in a mid-market. So that could be Texas, Tennessee, Florida, South Carolina, again, Ohio, other places like that. So I'm seeing these trends with our investors and what cities they're going into. Now, if you have more money to put down and you're okay purchasing a more expensive home, you're probably going to end up in the STR space because you want high cash flow, but it costs you a lot to get into it. So those are going to be your hot cities like Nashville,
STR means
Miami, STR, short-term rentals.
Okay, just making
Short-term
sure.
rentals. Yep. So you have to pick your strategy and you really have to look at it as how much money do I have to put down and put into this? What do I want out of it? Do I want high cash flow or do I want high appreciation, which is more important for me right now? And so if you don't have a lot of money, but you want high cash flow, you're going to end up purchasing properties meant for Section 8. If you have a lot of money to put down and you want high cash flow, you're going to end up on the short-term rental aspect. And if you're somewhere in the middle, you'll probably end up with a mid-range market rental that's going to cost you between, I'd say, $200,000 to $300,000.
Great. So lots of different strategies you can pursue in that. But again, the cool part about debt service coverage ratio, or DSCR, is that it provides an alternative financing range when your bank either don't give you any more money or and you don't have to pay cash, because again, it's all about having information. So this is really cool. Now, tell me, how did you get into that? How did you get into the strategy?
Well, actually, this coincides exactly with how I got into the strategy. I myself am an entrepreneur. And when you're an entrepreneur, you tend to have a lot of tax write-offs. So you don't qualify on paper to purchase these properties, right? Because you've got a great tax strategist, and you've got a great CPA, and they're working in tandem to make sure that you're paying the least amount of taxes. But also for a conventional loan, that I'm only making $40,000 a year or $50,000 or whatever is going on in your scenario. You're not going to be able to qualify for some of these over and over and over again with a conventional. So these loans are perfect for entrepreneurs who have great tax strategists, great accountants, and have a lot of write-offs. Because again, we're not looking at the amount of money you make on paper. We're looking at the amount of money that you have for a down payment, because you need to put a down payment of 20%, and also what the income of the property is. So it was really born out of living inside the bubble that I live in and saying, well, what's available for people like me? And that is its own niche. And that's why I understand it so well.
Yeah, but tell me about it. Like depreciation and tax write-offs is number one strategy for entrepreneurs to save money. So that's interesting. Now, how high can DSCR loans go? Like you mentioned that depending, you can start in the $80,000 to $100,000 areas. If you're going into Section 8, you can go into the several $100,000. Do you go into the 7 figures? Is there a limit to it? Or is it just a matter of the numbers game?
We can lend up to $3 million, and that is going to be on a multi-unit, because if you look at the amount of income you would have to make on a market rent on a $3 million property, I'm not sure there's many markets in the US that make that on a long-term rental. And then two, they're very difficult to underwrite. They're very difficult to pass because it's more of a jumbo situation. So if you're into the 7 figures, you're probably looking at a multi-unit, and DSCR you can qualify for a DSCR DSCR loan for up to 10 units. And so that's going to put you up to 3 million. And we've got a couple going on right now. It's a little bit heavier of an underwriting process. They want to see that you have experience in that range so that this isn't going to be your first property out of the gate. But we can go up to 3 million.
Now, is this a loan that is mainly for residential, or do you also do commercial?
Well, when you move into the 5 to 10 unit range, it's considered commercial residential, but it wouldn't be commercial as in you've got resi on top and storefronts at the bottom. It's all residential.
Okay, so you can't do a warehouse or an office building or things like that. It's all
Right.
It's people need to be living in there. So let's put it that way. So okay, very cool. And then so you mentioned before we started the recording, you mentioned that the industry is only 10 years old. How come? Where does this come from? How does this all get started? And then tell me now, let's go into into your history. How did you get started in the financing industry, and how come you picked that kind of industry?
So DSCR is always born out of necessity. Remember earlier when I mentioned you can go conventional, but once you max out with conventional, the only other choice you have is a hard money loan, which can be 10, 12%, maybe 15%, and also has a time limit. You can only have that hard money loan for up to 2 years. And then your other alternative is to pay cash. So none of those serve what was needed in the market. And so really the market said, okay, well, we need to build a bridge between conventional and these hard money / paying full cash scenarios for these investment properties. And so DSCR really became that bridge. They don't require as much documentation. So you will find that the rates will be about 1% higher than conventional. But again, it's because they're not underwritten based on a person's income. So the rate is going to match the underwriting, and that it's a little more lax on the underwriting. So
yeah, and the higher risk, the higher interest rate. But again, it came out of the necessity, but was the legal framework already there for it to be created? And it was just all of a sudden people say like, you know what, let's create this product because we can? Or did something in the legal framework change? Is it the result of Dodd-Frank, or is it a result of something like that the industry, that particular niche was created?
So if you look at who the loan buyers are in this industry, they're the hedge funds. They are the retirement funds for states and pensions and things like that. And so these hedge funds were looking for a different product to buy in the market that had good returns. And so if you have a whole pool of people maxing out a conventional, but you have a whole pool of buyers who want something, and then you've got the hedge fund money who wants to make money off of the buyers who want to buy the thing, then they are the ones who are going to create the market for the scenario of, well, let's put a product on the market that allows us to capture all of this. And so that's really, it's going to be fed by those who buy the loans at the end of the day. And, all of any loan is sold on the back end. And so really these hedge funds are who are driving the underwriting needs, the interest rates, everything that comes to DSCR loans. Now, another thing with DSCR loans you have to keep in mind is, again, because they're business purpose loans, when you're closing them in the name of your entity, they don't show up on your credit report. So when these loans don't show up on your personal credit report, they're not counting against your personal income, debt to income ratio. So and two, there's no exposure limit and no limit to the number of DSCR loans you can have. So as long as you always have the down payment for them, then you can purchase, say, 10 at a time. So I've got quite a handful of investors who have brought me their whole portfolio, and we're refinancing the whole portfolio at once. This could be anywhere from 5 to 25 loans at once. And it's because these investors understand where we are in the market, and that once interest rates come down, everybody's going to be clamoring to buy the properties. So they want to get ahead of it. They want to buy the properties at the price they are now before rates drop, and everybody clamors to buy the properties, which is going to drive the price up. So that's, kind of, if you're one of these investors and you see the trends of the market and how, I guess, the money game works, this is what you're doing right now, is a ton of cash out refis. And so that's what's heavy in our business right now.
All right, very cool. Now that thank you for that really detailed answer. That sheds a lot of light into how this works, and it makes sense. So the hedge funds set it up. That makes sense. They want to keep on potentially selling, buying, and now interesting thing. And so these investors that are getting into this right now, basically their outlook on the market is prices are stable. Perhaps in some markets prices are down a little bit, but they're basically expecting, they're bullish, and they're expecting in the next, whenever it is, year, 2 or 3 years. It's when the economy takes off again, or if the economy doesn't take off, whenever interest rates go down, that house prices actually go up. So it's more of an equity play for them than it probably is a cash flow play. Of course, the property needs to qualify for the debt service coverage ratio loan. It needs to provide enough cash flow to pay for principal, interest, what is it, Pita?
Taxes,
Principal,
insurance.
interest,
Yep.
taxes, insurance, and association. It needs to pay for all of that, but they're probably, can you speak of, when you look at these loans and the underwriting, do they pull a lot of cash flow out of these deals today? Or is it more like let's break even right now? If there's a little extra, great, because we want to build up as much, we want to buy as much as possible, so that when the market goes up, we have this great equity gain.
Sure. So first, if I want to do a quick education on the money game and the I guess the chess game of money and where we are in the market. So if you follow Ray Dalio's principles of economic machine, then you'll understand this, and you'll know that market cycles in the US tend to last 5 to 8 years. So with the 5 to 8 year framework in mind, know that in 2020, assets were cheap and money was cheap. Interest rates were low. Well, when interest rates are low, everybody can get access to money. So a lot of people can get loans. So with all these people getting loans, they're going to go offer, oh, I can pay 10% more. I can pay 10,000 more. I can pay 20,000 more. And they're going to drive the cost of assets up. So assets are going to become expensive. Houses drives the price up, right? So now we're in phase 2. Well, when that many people can get access to money and buy things, it drives the cost of everything up. That's inflation. So then the Fed decides, oh, there's too much money in the market. Let's raise the rate to get money out of the market. So this is phase 3, right? Well, the next logical thing in the series is if people can't get access to money, or psychologically they don't want to borrow money because it's too expensive, well, then less and less people are going to be offering to buy houses. So they're not going to be 10%, 20%, 20,000 over. They're just going to go back to normal. They're going to fall back. If they were inflated, then they're just going to fall back to what should be the normal price. Well, when not enough money is in the market and not enough people are buying things, then the Fed's like, oh, there's not enough money. Let's lower the rate. So then that would be back to phase 1. Right? So if you just follow what's happened since 2020, which is 4 years ago in a month at the time of this recording, we're 4 years ago in a month into a 5 to 8 year cycle. And if you know how the cycle works, well, you can expect what's next in the series and how much time it will be before we hit that. So you would imagine that if everything follows like it normally does, and we don't have some sort of crazy 2020 scenario again, then in a 5 to 8 year cycle, we're 4 years in, something's going to happen in the next 4 years, maybe 1 year, maybe 2 years, So people who play the money game of chess, see this and say, okay, well, eventually money's going to fall and everybody's going to clamor to buy the houses and the houses are going to go back up. So I'm going to go out and get as much liquidity as I can out of my current portfolio so that I can gobble up these houses at the prices they are now before the prices get driven up. So the question about cash flow is, again, it depends on your strategy. People can cash flow heavy in these Section 8 markets. So if you're purchasing properties for 80 to 100,000, but in big metro areas like Detroit and Philly and Cleveland, then you're going to have county programs who pay $1,100, $1,300. I've seen even $1,600. Well, if your mortgage is only $500 to $600 a month because the property cost is so low, and you only had to pay 15 to 20% or $15,000 to $20,000 to get into it, but you are cash flowing $1,600, well, that's $1,100 cash flow per month on one property. So if you're able to then take your $100,000, instead of buying one property that cost $500,000, and say the cash flow is only going to be 10 grand a month if you're doing an STR, or say it's only 2 grand a month if you're doing a regular market rental, and instead you take that 100,000 and you buy 4 to 5 properties, well, now you're cash flowing, say, 48,000 a year. So I tell this story, or I tell it this way, because I had a client who is a single mom. She was left, for whatever the scenario is, she was just left and blindsided in the divorce. And she has these little kids, and she was a stay-at-home mom, and she never worked, and she didn't have a career. Well, she was left with a $200,000 settlement from the divorce. As you can imagine, $200,000 will only last maybe 3 years when you have little kids. But what she did is she took half of it and she bought 2 portfolios of 3 properties each, that each cash flow $1,000 a month. So she's got $6,000 in cash flow per month. That's $72,000 a year. So she essentially bought a $72,000 a year salary Yes, it's rental properties. Yes, you have to put money aside for repairs and for when there's vacancies. But just imagine, even if it's $60,000 a year for the next 30 years, because now she's got these rental properties. So it really can be life changing if you're going at it from a cash flow game. If you want to go from the appreciation game, then you're going to be mid market or say short term rental if you can handle managing the short term rental to create the cash flow. So it really depends
If you're
on
doing
your
this
strategy.
right, if you're doing
You
this
have to
right, you
decide that
can.
going in.
Yeah, so if you're doing this right, you can actually pull a significant amount of cash flow out of these properties. Of course, with the lower end, I have had my personal experience. I bought a whole bunch of $60,000 houses in Cleveland and also in Omaha, Nebraska, and rented them for $1,200 a month and bought them free and clear, paid cash for them, and never made a dime on cash flow because they constantly required like a boiler, a foundation crack, a you name it. Every month there was they on paper made me $15,000 to $20,000 a month, and almost every month there was a $15,000 extra kind of thing where somebody trashed the property, moved out. Of course, with Section 8, you can avoid a lot of the trashing and moving out because people stay there longer. But yeah, but in theory, it makes sense. And if you pick the right properties in the right markets and the right kind of tenants, then it actually can work. And I think Section 8 is the way to go. That's probably what I should have done instead of just putting it on general to the general market and getting a bunch of people that just lived really hard on the properties and left them with $12,000 rehabs afterwards after they're in there and a midnight move out after a year. And now the entire cash flow of 2 years went out the window and so on and so forth. But that's my personal experience. But what you say is certainly true. And if you pick the right tenants, and that's, I think, the message on here is like, if you can get the financing, and the beauty of that with DSCR loans, you can get really, as it sounds like, as many financing as you have the down payment for. And there's some really good exit strategies that if the market takes off again, you build equity. And but what I'm surprised by and what I'm glad to hear is that you can actually also make some good cash flow from it. So really cool, really cool. So so now they started with the hedge funds and they wanted to make these things work. And then how did you get into this?
So interestingly, I did loans while I was at university. So I worked in school and paid for my own school. And one of the job that I had was to sell loans over the phone. And what I would do is I would call people who had adjustable rate mortgages and whose rate was about to adjust upward. And we would offer them a fixed rate mortgage. And so it was just like one of those smile and dial call centers. And eventually, I became the manager of the team, and then I graduated and I sort of exited the loan world and went into the tech world. And I spent a decade in tech. And, in 2020, I just had my own spiritual awakening. And I realized I was good at what I did in tech. I was successful. I achieved success for my clients. But I didn't like it. And, you kind of like hit one of those, I don't know, what age your listeners are, but some people hit the point in life where they're just like, what I bought into is not what I actually want. And so I just kind of threw my hands up in the air I think it was like March or April of 2020 and said, you know what, I'm just going to I'm going to see what happens. I'm not going to promote myself anymore. I'm not going to try to seek additional tech clients. I'm just going to go with my friends and travel. And, at the time I lived in California, Southern California, so everything was closed and it was horrible living there. And so we would constantly go down to Mexico. We would get a house together and all go down to Rosarito or Tulum. And so one of the people in the group, and this was like a group of like 10 to 20 people at a time, we'd be like pockets going and planning our travels. One of the people in the group, I said, what are you working on? And they were a brokerage. And he said, we're so busy, we're dropping deals on the floor. I was like, well, you know that I scale companies for a living. That's what I've been doing in the tech world. I can come in and build out the scalability of your company. And then when I got into it and realized, it's a little bit easier than what I've been doing. And the thing that really struck me is it's not just helping one tech founder. It's not just helping one tech founder become a millionaire. It's helping the everyday American become a millionaire. Like, I really like this product. And so I said, why don't you let me close some loans for you guys? So I did that for a while. And then about a year and a half later, I found myself at a conference where it was a room full of BRRRR investors. That's where you buy a property for really low, you renovate it, you then rent it out, and you come get a cash out for the new equity based on the new ARV. And, they were pummeling me with questions, and I had the answers, but then I realized the loan products that I had for the brokerage I was working with would not serve them. So being the entrepreneur I am, because this is my 5th business at this point, I decided, I can go out into the market and I can find capital partners who can serve my clients, and I can find those exact products that they need, and I can create my own brokerage. So then, I found a couple of capital partners. Took a couple months. And once I had put together a product that would serve them really well, I reached back out to everybody on the list from that conference and said, I've got this amazing product. We can go up to 80% LTV on cash out refis, which was 5% more than they were getting. They ended up all coming to me at once. I opened my brokerage, and then I've been doing social media content ever since. And so that's been about 2.5 years ago.
All right, very cool.
Yeah.
Now that makes that's a power of seeing the opportunity, and the time is right, and being at the right place at the right time, and more importantly, being prepared for the opportunity. So congratulations, that's really exciting. That's really amazing. So good. So now, how does somebody get? Somebody wants to do this. Perhaps somebody wants to either. Like we teach people how to flip land, and a lot of our people make a lot of money with flipping land. So there's a lot of people with money on the sidelines. And what I also tell everyone is, like, once you make a bunch of money, what you want to do is, like, of course you can do bigger and bigger and bigger deals, but you want to start transitioning from active income to passive income, relatively passive income, because every once in a while you still need to deal with a rehab and a thing and a broken, again, foundation or things, other kind of stuff. But it's more passive than any kind of active business income. So there's potentially quite a few people that make good money and that want to get into the space. So if they find some deals that qualify and so on, how do they get a hold of you and get you a share? I'm happy, let us know how people can find you.
Yeah, my website is getbrickcapital.com. So GETBRICK capital.com. And I am at the Bridget Brick on all social media platforms. So I've got a huge following on Facebook, relatively decent following on Instagram. My links to my intake form are there, as well as on my website with Get My Quote. You can click Get My Quote, and it's just an intake form to give us the deal summary. So at that point, we're not pulling your credit. We're not asking for your social. We just want to know the numbers around the deal, what you're thinking, to see if we can get you qualified and what your rate would be. And then we'll send you over like a rough rate quote. And if you move forward, then we send the formal application. So it's pretty simple. And yeah, it's really for anyone who they want to get into real estate, but did not know that this product was available. And now it fits sort of that bridge of what they thought they would have to do. Yeah,
absolutely. Wonderful. Great. So thank you very much for being here with us. I love that subject of DSCR. I'm slightly dyslexic. I turn letters and numbers around. So that's why I sometimes even prefer pronouncing it. Debt service coverage ratio, that I don't forget. But DSCR, I turn the letters around sometimes. But hey, that means you can still be successful even if you're dyslexic, like me. So with that said, thank you very much for being on the show with me. Our listeners have certainly learned a lot. Like, guys, you understand, there's more than just bank lending out there. There's more than like paying cash, getting a bank loan, hard money lending, but there's something in between, which is a DSCR loan, right?
That's right.
Where the property qualifies for it. You only have to have your credit score, and everything else is done for you. So that's that. Thank you very much. This is a wrap. As always, guys, make sure you share this with friends. You put in there, you let everyone know. You hit that subscribe button. You hit that notification button if you watch it on YouTube. You give us a 5-star review. With that said, I'll see you in the next episode. Thank you.